What if one day you woke up, and the money in your bank account meant something different than it did yesterday? It's not because of inflation, not because of a recession, but because a small group of unelected officials quietly made a decision. A decision that changed the rules of money without your permission, without your vote, and without a single headline warning you it was coming. Most people believe money works the way it always, stable, predictable, constant, but history tells a different story. Because every few decades, something happens. A crisis, a war, a collapse, and in the shadows of panic, central banks step in, not just to save the system, but to rewrite the rules that govern it. Today, we're going to uncover how they do it, why they do it, and the hidden pattern that is repeated for over 300 years, a pattern that may be repeating again right now. To understand how central banks gain their power, we need to go back to a world before they existed, a world where money wasn't digital, wasn't paper, wasn't created with a keystroke. Money was gold, heavy, finite, unforgivable. It didn't need trust. It didn't need regulation. It didn't need a central bank. Gold kept governments honest, and governments hated that. War, expansion, empire building, all of it required resources far beyond what gold supplies allowed. So rulers found a workaround: paper promises, certificates, notes, IOUs. What began as simple receipts representing real gold soon evolved into something more powerful and more dangerous. Banks realized they could print more notes than the gold they actually stored. It was the first quiet bending of the rules, the first moment where money drifted away from physical reality and toward a system of trust, confidence, and manipulation. This was the seed from which modern central banking grew. How control slowly shifted from gold to policy. The early central banks. The Bank of Amsterdam, 1609. The Bank of England, 1694. These weren't just banks. They were early prototypes of centralized monetary power. Their promise: to keep money stable. Their effect: to give governments a financial escape hatch. Instead of raising taxes, which was unpopular, governments could borrow from central banks. Instead of being constrained by limited gold, central banks could issue paper representing future gold. The rules were already shifting. But the most important pivot happened in 1913. The Federal Reserve, a new superpower, is born, 1913. Created in secrecy on Jekyll Island, the Federal Reserve became the most powerful financial institution on Earth. It could adjust interest rates, expand or contract money at will, lend unlimited funds to the government, but what mattered most was something almost nobody noticed. The Fed turned money into debt. Every new dollar entering the system became borrowed, owed, and tied to interest payments. Money was no longer something you had. It was something someone owed. This was a foundational rewrite, one that permanently changed the architecture of the global economy. But the world still had a stabilizer, a final anchor holding money to something real: gold. That anchor would not survive the 20th century. Wars are expensive, far more expensive than any nation's gold reserves. So during major conflicts, countries often temporarily suspended the gold standard. Temporary, just like inflation sometimes is. Just like emergency government powers often are. Every time the gold backing was suspended, it came back weaker. Rules bent. Rules stretched. Rules changed. Then, after World War II, the world attempted to restore discipline with the Bretton Woods Agreement, 1944. It failed. Bretton Woods stability built on fragility. 44 nations agreed. Global currencies would peg to the US dollar. The US dollar would peg to gold at $35 an ounce. This created the illusion of stability. But behind the scenes, the US printed far more dollars than it had gold to support. Foreign governments began demanding their gold back, and once again, money faced a breaking point. On August 15, 1971, President Richard Nixon shocked the world. He ended the dollar's convertibility into gold. The words he used were carefully chosen: temporary suspension. But the truth? It was permanent. From that day forward, money had no physical backing, no inherent value, and no natural limit. It became fiat value by decree, enforced by authority. This was the greatest monetary rewrite in modern history, and it opened the door to a new era: unlimited money creation, unlimited government debt, unlimited financial engineering. The modern financial world began here, and its consequences are still unfolding. Once money detached from gold, the economy became addicted to growth, constant growth, at any cost. Governments borrowed more, corporations borrowed more, consumers borrowed more. And central banks made it all possible by manipulating interest rates. When the economy slowed, central banks cut rates. When crisis threatened, they printed new money. This created stock market bubbles, real estate booms, corporate debt explosions, recurring cycles of boom and crash, but the biggest fallout came in 2008. The 2008 financial crisis was not an accident. It was the logical outcome of cheap money, risky lending, excessive leverage, financial products built on unstable debt. When the housing market crashed, the entire global system nearly collapsed. What did central banks do? They did what they always do during crisis. They rewrote the rules again. They introduced near-zero interest rates, unlimited liquidity injections, quantitative easing, central banks buying assets, emergency lending facilities. This was unprecedented. For the first time, central banks became active participants in financial markets. They weren't just referees. They became players. The markets learned a dangerous lesson. Central banks will always step in. They will always print money. They will always rescue the system. This created moral hazard on a global scale and set the stage for the next phase. After 2008, central banks kept rates near zero for nearly a decade. This inflated asset prices to record highs. But nothing compares to what happened in 2020. Faced with global shutdowns, governments and central banks launched the largest money printing campaign in human history. In just 2 years, the U.S. printed 25% of all dollars ever created. Global central bank balance sheets exploded. Debt levels soared. Stimulus checks, subsidies, business bailouts flooded the economy, and the result: the highest inflation in 40 years. The cost of living surged. Housing affordability collapsed. Currencies weakened worldwide. People felt poorer because they were. The rules had changed. Dagan citizens paid the price. Look at what's happening right now. Global debt has passed $315 trillion. Interest payments alone threaten national budgets. Inflation remains unstable. Central banks flip between rate hikes and emergency interventions. Markets depend entirely on policy, not fundamentals. And now another rewrite may be coming. Central bank digital currencies, CBDCs. Unlike crypto, CBDCs are fully controlled by governments. It could allow programmable money, spending restrictions, automatic taxation, expiration dates on savings, total transaction tracking. This would represent the most extreme rewrite of monetary rules ever attempted. And it's happening fast, with over 110 countries already testing or developing these systems.
The question is on whether the rules will change again.
Are you prepared for what happens when they do? 1. Every major crisis leads to new monetary rules. From gold to paper, paper to fiat, fiat to QE, the rules change whenever the system becomes unstable. 2. Central banks now control the financial heartbeat. Interest rates, liquidity, money creation, nothing in the modern economy moves without central bank influence. 3. A new rewrite is coming. Digital money, global debt, inflation, pressure. The system is reaching another breaking point. Each rewrite shifts power away from individuals and toward institutions. And every shift has a cost. Savings lose value. Assets inflate beyond reach. Debt becomes inescapable. Ordinary people pay for decisions they never agreed to. If you don't understand how the system works, you become part of the system's fuel.